In this introduction to inventory video, we're going to talk about how inventory moves through our business and how we capture the information that we need. Welcome to Accounting How To. I'm your host, Carolyn Grimm, and this is my replica of my sidekick, Terrance. And we're here to put the fun in accounting fundamentals. Now, when we're talking about inventory, we can have either physical products that we're selling in a store, or we could have raw materials that we're using in a manufacturing business in order to create a product which we then sell. The concepts for both of those items are the same, whether it's raw materials or finished goods that we're selling. Now, inventory is a huge piece of a business that needs to be controlled. We need to track those costs very carefully. When you think about a store chain like Walmart, for example, think of all of the merchandise they have on their shelves in every single store across the world and in their distribution warehouses, and then goods coming from all over the country and all over the world into their warehouses. That's a huge amount of business assets to have to keep track of. So if you have very thin profit margins, let's say they're 3%. If you have a 1% increase in your cost of goods, that can have a huge impact on your business. So controlling inventory is a really important piece of how we do business. Now, we have a couple of different inventory methods that we can use in order to track inventory. We can use either perpetual inventory or periodic inventory. Under perpetual inventory, everything gets tracked from the moment it arrives until the moment it goes out the door. So it's coming in the back door into the warehouse, and then it goes out onto the shelves, and then it goes through the cash register as it goes out the door. And we capture that information at every step. We are recording it when it comes in. We just got 10 new Terrance stuffies, and then we record it as it goes out the front door. We just sold 10 Terrance stuffies. So under perpetual inventory, we're constantly tracking those items as they come in and go out. And that's how Home Depot can tell you whether they have a mini dorm fridge in stock at your local Home Depot store. And then at some point, usually the end of the calendar or fiscal year, the store will have an inventory done. So I'm sure you've seen in stores when you have the inventory crew descend upon the store and they're going around and they're counting absolutely everything. So the reason for that is to see whether our inventory numbers are accurate. So if our inventory says that we have 10 Terrance stuffies and we go to the shelf and we count them, then we maybe only have 9, or maybe we have 11. So the physical inventory is a way of double checking what we think we have in our inventory. So why might it not be the same? Well, there's a variety of reasons, and a lot of them are paperwork errors. So if, for example, we receive a shipment of Terrance stuffies and we have ordered 10, well, we don't really count them when they come in. We just assume that they're there. We don't open the box. And maybe there's only 9 or maybe there's 11, but we book it as being 10. So paperwork errors, pretty common. We could also have spoilage. So maybe we have a case of Terrance stuffies stored in our warehouse, and they're sitting beneath a pallet full of dinosaur shampoo. It could happen. Okay, so the shampoo leaks, destroys the Terrances down below. They get soap in their eyes. There's crying. There's little dinosaur tears. And this is no longer saleable merchandise. So an inventory would reveal those kinds of things. We could also have people who steal from our store. Maybe they just can't resist that dinosaur and it walks out of the store without going through the register. It happens. So a physical inventory helps us to tie that information out. So let's stop here for a moment and revisit the matching principle. The requirement of the matching principle is that we match the expenses in the same period with the revenue those expenses are earning. So if we sell 10 Terrance stuffies in June, then in June we also want to record the cost, what we paid for these, so that those revenues and expenses get matched up in the same month. So under perpetual inventory, every time we have a sale, we also have a secondary transaction that records the cost. So let's take a look at that. We're going to have a sales transaction, and either our customer is going to pay us cash, we'll debit cash, we'll credit our sales revenue account, or our customer is going to order a bunch and they're going to pay later. So we have accounts receivable and sales. At the same time that that sales transaction happens, we want to have a recording of the cost that goes with that sale. So if we sell a $10 stuffy and we paid $5 for it, we're going to say debit cash for $10, credit revenue for $10, and then we're going to say debit cost of merchandise sold or cost of goods sold, and we're going to credit our inventory account. So we're taking it out of inventory and moving it into our expenses so that we can match up that sale with the expense. Now it's different under periodic inventory, because under periodic inventory, we only record the sale when the sale is made. We don't record the cost at the same time. So how do we figure out the cost under periodic? So at the end of the month, we're going to go out into our store and we're going to do a physical inventory, and we are going to count everything that's out there. And then we're going to start with what we started with, our beginning inventory. We're going to add to that whatever we purchased during the month, and then we're going to subtract from that what our ending inventory is. The difference between the two will be what we record as cost. Now, don't get too hung up on this yet, because of course, we have a whole video comparing periodic and perpetual inventory, and I will link that in the description so that you can go in depth as much as you need to with that. Now, how do we determine what the cost is that we're going to use for our merchandise? So let's think about this. So we bought this month for a certain price. We bought them last month, possibly for a different price. And the month before, maybe they were a different price as well. So now in this little bin full of tiny Terrance stuffies, we have a whole bunch of these. And you cannot pick one out and say, we paid $5 for this one right here, and that one over there, we paid $4.20. We don't have any way of knowing that because they're all in a bin all together. So what are we going to do to determine our cost? Well, we're going to make a choice on how we do that. So what we're going to do is we're going to choose an inventory cost method. And it's usually going to be FIFO, first in, first out, LIFO, last in, first out, or average cost, AVCO. Now we've got a video for each one of those so that you can see how those methods work and how those different methods impact our financial statements depending on the choice that we make. Now as we dig deeper in this merchandising business playlist, we're going to look at purchase transactions and sales transactions, so that you've got a good handle on details that go along with each of those. So details like purchase discounts, sales discounts, allowance accounts, and shipping costs. And all of those videos, of course, will be linked in the description to make it as easy as possible for you to find what you need, just like we do in the Terrance store when you need some dinosaur shampoo. Until next time, stay balanced, my friends.